So what I'll talk about in today's video is what I've seen a lot of business owners that we've worked with over the years do with their whole life insurance policies. What I'll focus on is how their policies are set up, how they use their policies for their business, specifically through policy loans. I'll go through the pros and cons of that, and then what the end result is, which is really the main reason why they're putting money into whole life insurance policies. And a lot of times we'll see business owners, especially those in the $1 to $3 million revenue range. It's typically an owner of an LLC or an S Corp. It's a pass-through entity. They have 0 employees or somewhere between 1 and 10. It's a small company, but they're really aggressively funding this policy and then using the policy to cover expenses with their business and continue to grow their cash value, grow their wealth, call it. So let's start off with what they're interested in with a whole life insurance policy. It's always the cash value first. So when you look at the cash value of a whole life insurance policy, why a business owner that we work with will express, I want this, is number one, it puts them in a better spot today than where they were yesterday when we look at what they're doing with their money. Whether they were going to a bank to borrow money or they're using cash, they like using the cash value in a whole life insurance policy more. Number two, it's very convenient. When it comes to accessing the money, it is extremely easy to do. Typically, when you request funds from your life insurance policy, they hit your bank account via direct deposit in 2 to 3 business days. But then the big reason is this guy right here, control. I have complete control of my money. Whenever I want to access it, I easily can. If I access it through the loan feature, I can pay those loans back however I want, and whenever I want, I can even not pay them back. My point is, I have a lot of control, and we'll look at a model with the policy loan in a little bit. But those are typically the main reasons, just to summarize, why we see business owners interested in cash value life insurance. So how it works, I'm going to simplify this. A business owner is going to put money into a policy. This is usually a policy that the owner owns. So the policy is on the owner's life and they own it in their own name. Sometimes they'll own it in the company's name, depends on their situation. But after they put that money into the business, they're turning around and using that money for their business because their business is going to earn them the most money, the highest return. But why they want to use their whole life insurance policy instead of just using cash in the bank is because once money flows through the cash value of a whole life insurance policy, you keep earning interest on that money forever. Meaning, I can put money into a whole life insurance policy, let's pretend it earns 5%, and instead of just letting it sit there and grow, I can take that money out, use it for my business, which will earn a return, but still earn 5% on the money that I've accessed. Now, there is a cost to borrow, which we'll go through exactly what that is and how to look at it, but that is generally a huge point of attraction to a business owner. I can put my money into a safe account, it continues to produce interest, but use it at the same time. That's extremely interesting to a lot of business owners. Next, some of the drawbacks. So here are the main drawbacks. The first year is always the worst year with any whole life insurance policy. I am a huge advocate of designing a policy with the absolute minimum insurance expenses that the insurance company will allow. My background before I got into the game of owning a business and such, my background was working at an executive benefits planning firm, and my role was the back office. I would design policies for maximum cash value for a corporation. The corporation would look at the life insurance policies typically on their top executives, but they'd look at the collective cash value, and it would be an asset on the balance sheet. So in order to minimize the negative hit up front, this way we don't see a negative hit on the P&L, we want to beef that cash value up as much as possible. So really, all we do at our company is the exact same thing that I would always do for corporations when I was setting those policies up, maximizing the cash value. But with that said, even when a policy is set up for maximum cash value, the worst year is still going to be the first year. where I have a 10 to 15% loss. It's on average going to take me 3 to 5 years before I see a positive return on my cash value. And I'll go through a model. It'll be an illustration that shows you exactly how that works. And then another drawback to a lot of people is the loan interest. However, when I look at the upside that I get, it's typically more than a fair trade to most business owners. So what I get is, number one, guaranteed growth. Who doesn't want that? Especially in a low interest rate environment, this was extremely appealing, and it still is today. Here's a big one. If we do everything right, when I say if we do everything right, I'm mainly talking about the agent, so me or any agent that you're working with. If we do everything right, you can use that money tax-free, which if a business owner is very profitable and he's paying a high tax rate, that tax-free benefit is going to be extremely attractive. But then down here, bullet point number 3, I can use the policy, specifically the cash value, as my own line of credit or as my own bank. And I'll show you exactly what I mean when we look at an illustration, and we'll go through a model of showing a policy in action with loans and such. But that's the upside there, and a lot of business owners are attracted to all 3 of those points. Using the cash value as my own credit line, that's huge, because now I don't have to work with a bank and go through renewing credit lines, going through underwriting, dealing with all the paperwork, saying the interest rate's higher now. Like, we don't want to deal with that stuff. It takes forever. So if I can get control and use the policy instead of a bank, you've got my interest. This is usually what I see and what I hear. So, a popular strategy. This is like the strategy I see the most with business owners. What a lot of people like to do is fund a policy for a short period of time, typically with a large percentage of profits or revenue. And you'll notice here that they're funding a policy for 3 to 5 years. So they want to aggressively fund the policy, then they want to borrow the money that they're paying into the policy for their business. Now, when they're borrowing that money out, they are paying interest on those loans that they're taking. So they're putting money in, taking that money out. While it's coming out, they're paying interest only. Remember, they're still earning interest the whole time, but I'm not paying the loan principal. After the 5th year, assuming that I funded a policy for 5 years, I'm going to stop the funding. So I'm no longer going to pay money into my premium or riders that grow the cash value. I'm going to stop that and dedicate the money that I was paying toward the policy now toward repaying the loan. Make sense? So I've got the same cash flow going in, but I'm redirecting it now toward the loan. And the reason why a lot of business owners like to do that is because they say, if I can get a lot of money into this policy over the next 5 years, say it's $100,000 per year for 5 years, that's $500,000. That $500,000 is compounding for me forever. I can now use it for other opportunities. I'll pay the loan interest up front. I'm okay with that. But I like the idea that when I pay that loan back, that $500K has earned interest for me the whole time, and I see it fully restored to $500 plus all of the interest. If that doesn't make sense, we're going to look at an example that demonstrates exactly that with the $500K total. So, leading into the example, here's what we'll look at. 1, we'll look at the policy setup. This is the most important part. If we don't get this right, everything else takes too long and people eventually cash out the policy. But first, we'll look at the policy setup and how to get that right. Number 2, we'll go through policy loans. And then 3, we'll look at the end result. What does everything look like once I pay all of those loans back? So what we'll look at is a life insurance illustration. There are several sections that you can look at in an illustration. We can go down to the supplemental values, which gives us a full policy breakdown. I like this section. However, I'm just going to go up here. So this is on an individual who is 48 years old. At the end of the first year, age end year, he's 49. What do you see here? 100K, per year for 5 years, total of $500,000. There's your net cash value. At the end of 5 years, you've got 516. Net annual cash value increase. You paid in $100,000 in the first year. Your cash value is $89,401, and it shows an increase of $89,401. Do you agree with that? I don't. Let's break this down in Excel. So, what we've got here is the exact same illustration we just saw just on Excel with colors that make things easier, in my opinion. So, first, we've got the minimum premium. Of the $100,000, 10K is going toward the premium. In the first year, this takes the biggest bite out of cash value. Premium dollars typically do not show up in cash value in the first year, and sometimes the first and second year with a whole life insurance policy. The reason why is because they satisfy the death benefit on a life insurance policy. So we've got the minimum premium, $10,000. Why it says minimum is usually with the top companies, we can push that minimum premium as low as 10% of whatever our total deposit is. So in this case, we're paying $100K per year. 10% of 100 is $10,000. Sometimes it's less than 10%, sometimes it's a little bit more. It does depend on the insurance company that we select. PUA rider, that stands for paid up additions. I like to call that a cash dump in. That's where we're paying everything else. This is also optional. So in this example, we're looking at the premium and PUA paid at the exact same time. However, what a lot of business owners do is set a policy up where they're only committed to the 10K per year, and then that PUA piece, they add at their leisure. Whether they hit 90 some years, 20 some years, 50 is completely up to them. My point is, you can set it up to be very flexible. This way, you're not just billed for the same dollar amount every single year. Then we've got the total annual funding of $100K per year. Total funding tallies up all of your payments. What's highlighted in yellow represents your break-even point. Remember where we said the drawbacks, what's the first one? The first year. You paid in 100, you have $89,000 in change in cash value. We said it's between a 10 and 15% hit. Here, it's just about 10% when we look at it. That's close to 11% really. 3 to 5 years to get our money back. What that means, we're paying $100K per year. In this example, by the 4th year, our cash value is finally equal to our total deposits over time. Year 3, we're still 10 grand short. And then after that, it just continues to grow. Then we've got our death benefit. What do you notice here? After the 7th year, the death benefit drops. This is not automatic. This is an option that we made here. I did this on purpose. And the reason why is because most business owners we work with typically say these exact words. I don't care about the death benefit. I'm like, okay, no problem. It does have some value, but I'm not going to force it on you. They're interested in the cash value. What you can do with a life insurance policy after the 7th year, in a case where we are funding it for 7 years or less, we're only paying in for 5 years here. So if we're paying in 7 years or less, we can reduce the death benefit like what we see here. And what that does is reduce the costs and allows the cash value to grow at a faster pace. Does that make sense? It's optional. Some people do express that they'd like to keep a high death benefit. So what we would do in a case like that is show this exact same policy, but without reducing the death benefit, put them side by side so you can see the net difference in cash value performance. But you don't have to decide up front. That's a change or an adjustment you can make after you start a policy, no problem, which is pretty cool. So we don't have to feel like we're forced to make a decision now that's going to be intact for the rest of our lives. Going back to that illustration, this column right here, do you agree with it? because I don't. First year, you paying 100. It says net cash value increase, $89,401. I don't agree with that because you paid in. If this is you paid $100,000 and you only have 89 and change. That means you lost money. So what I like to do here is create an additional column. We'll call it cash value growth or annual cash value increase that displays simply what we are receiving from the insurance company. So in this example, it's the same example, but on this sheet, you pay in 100, you have 89 and change. There's your loss in the first year because you did lose money technically. At the end of the first year, you're at 89.4. You pay 100. If you just add 100 to 89.4, you'd be at 189.4. Yet you're at 186, which means we have a loss there. So see what this is doing? The next year, you pay in 100. If you just add 100 to 186, you'd be at 286, but you're at 290. So you got your 100 back plus another $4,400. This isolates what you're getting from the insurance company year over year. Make sense? Cool. All right. So next, we're going to look at using the policy. So we looked at the policy setup. Most important thing, make sure we have no more than a 10 to 15% loss in the first year, and we break even between 3 and 5 years. Next, we're going to look at loans. So we prepared the loan illustration. This thing's broken up on multiple pages. So what I'm going to do here is just look at it on Excel. Whenever we look at loans, I have found it to be extremely helpful when we look at the loan illustration next to the growth illustration. This way you can see the impact that loans have had on your policy. So to the left, we've got growth. Now we're going to look at the loan illustration. In this example, we're not going to take loans for the first 5 years. A lot of people will, but the reason I'm not is because I want to show loans after we fund the policy. It just makes the numbers cleaner and easier to follow when you're learning this. It did for me. But you can see these different columns. Annual loan, that's money you take. Loan balance, that's the total balance. Loan payment in light blue, if you're going to repay the loan, we're going to have it in this column. And then of your payment, you'll see how much is applied to loan interest and how much is applied to the loan principal. And then we've got your cash value and death benefit. So here's the big thing. When you take policy loans, you're going to continue to see this same cash value growth. The growth will occur on your total cash value even if you have a loan outstanding. Keep that in mind. We take a $300,000 loan. What happens to your policy when you take that $300K loan? What's the impact that it has on your policy? Well, before loan, your cash value was $539. After loan, cash value is $539 before loan, and your death benefit was $1.987. After loan, on the far right, those values reduce by how much? $300,000. Because you took a $300,000 loan, your cash value, think of that as your equity. That's how much you can access. So you could take out additional loans if you want. But your death benefit is collateralized when you take out a loan. That's really how the insurance company does this. A lot of people will ask, how does the company make money on this? Remember, their first and foremost obligation is to pay out life insurance claims. So if you have a loan outstanding and you die with that loan outstanding, the insurance company will pay out the death benefit minus the loan. The death benefit on your illustration will display that net dollar amount that's going to be paid to your beneficiaries. So we take the $300,000 loan, and then what we've got here, no payments in the first year. Then we start to pay it back at $50K per year. Okay. You can see how much is applied to the loan interest how much is applied to the principal. And what do you notice at the bottom here? At year 15, when everything's paid back. Cash value is $840. Death benefits 1.2. If you compare that with the example to the left, what do you notice? They are identical. There's no change at all there. So when you paid your loan back, you saw your values as a business owner 100% restored to what they would have been over here if you never touched it in the first place. That's it right there. As far as what people are interested in, they know that their money will continue to compound at the dollar amount they see here, but they can also use that money for their business, which is going to earn a way higher return than what we see on this chart. That's where we're going to earn the highest return. And I can do this instead of just using cash, or instead of going to a bank to borrow money from them and then have to pay it back at their terms and deal with all that stuff that I don't like to deal with. So the biggest drawback here in this particular strategy, there's two things. One is the upfront cash value. If you feel, hey, if I put $100K in and I've only got $89,000 and I can use that other $10K for my business right now, probably wouldn't do this. I would wait until you're in a position where you're very profitable and the upfront hit does not hurt you that much. Or you could look at it and say, hey, that's excess profit that I was going to take for myself anyway, and I am more than comfortable giving up that minimum hit up front in order to capture the long-term benefits. That's typically what people are looking at there. So it's the upfront hit and then the loan interest. But when we look at the loan interest, what you can do here, I usually like to put these side by side, but just look at year 7 at 55 years old. How much do you pay in loan interest? $15,690. It's because you're paying interest on the $300,000 loan balance. But what are you earning interest on? Not 300, 564, the full cash value. So your growth that year was 24.5. So you're getting $24,500 from the insurance company, and you're paying the insurance company $15,000 in change. The reason why is, again, because you're earning interest on the 564 and you're paying interest only on the 300. So you're going to pay interest on what you have outstanding and you'll earn interest on everything. Just like real estate. If you own a piece of property and the fair market value goes up by 5% every year, you get that 5% on appreciation on the entire property value. If you have a loan outstanding, you pay interest only on the amount that you borrow. But it doesn't matter if you have a loan outstanding or not. If the fair market value goes up, you get that appreciation on your entire property value. So this is usually what business owners like to do. Typically, they're taking loans a bit more frequently, and sometimes they'll do something like this. Because if you own a business, do things always go according to plan? They usually never go according to plan, right? Or I should say it's very rare. Something comes up, like I didn't account for that, or where on earth did all of my time go? I feel like I was robbed of it. I was venting about that earlier today because I had to go up to the dentist, but I'm glad I did. Anyway, here, exact same scenario. What we're going to look at is first, that $300,000 loan. Let me go back actually. So back to this guy. First, we'll look at that $300,000 loan. But what do you notice here? What do your payments look like? Nothing. We took a $300,000 loan and paid nothing back at all. Then we take another loan for $200,000. Look at our equity go down even more. Don't pay anything back for a while. We'll assume that we can't make interest payments, nothing like that. So what we've done here, we paid in $500. We took out $500. These loans hit our bank account. We let the interest ride. So the interest has accumulated or has resulted in the loan balance accumulating to $732,000. but then we begin to repay the loan at 100K per year down here. And when it's repaid, there's your cash value, there's your death benefit, everything is 100% restored to exactly what it would have been. And the returns I earned with my business were likely much higher than the interest that has accrued over time. That's why people do this. I can also defer the interest payments as long as I'd like because I have the control and it's not with a bank. And I'm also earning interest that whole time anyway, which helps offset the fact that interest is accruing. So I hope that made sense. This is just a strategy that I see with business owners really the most with the short funding period where they aggressively fund it, have a big bucket of cash value, and use that big bucket of cash value as their own bank or as their own personal line of credit for their business. So I do hope this helps. Let us know if you have any questions at all, and thanks so much for watching all the way through. I do appreciate it. Until next time, thanks so much.